Good morning, everyone, and welcome to today's SAFCA webinar in partnership with FTI Consulting, where we're going to look at FTI's 2021 Valuation Survey results. Now, the last 2 years have been very difficult for the private equity industry. We've seen the macroeconomic impact not only on private equity industry, but the industries that we invest in. And we've seen changes to operating models and the way that we do business. Some of the changes that we've seen is moving over to digital due diligence using technologies such as drone technologies and others to be able to do a digital due diligence in lieu of a physical due diligence. We've seen longer fundraising cycles and longer holding periods. We've also seen a greater support needed by the portfolio companies within our portfolios. And we've seen the onslaught of digital disruption, both from a negative and a positive perspective, where some industries have almost been eradicated by the changing consumer behaviors, but it's also boosted other industries and possibilities and opportunities to invest in other industries. Now, today's webinar is definitely focused on valuations portion of our business. And in the SAFCA survey, we did see that even though we've had a very economic and tough time, we were still able to raise 16.9 billion as an industry and invest 14.5 billion. So it does show that the industry is agile and can adapt with the changing economic times. Now, today's FTI valuation survey will seek to understand how business valuations have been affected by economic effects such as the lockdowns and the restrictions, the new variants that we saw, and anticipated global recoveries, and really how these have been incorporated in the valuations and whether the conventional matrices and models need to be adjusted. So to lead that conversation is Toba Bukwana. He's Head of Valuations at FTI Consulting in South Africa. And with our other webinars, please use the QA function to ask questions, make comments. Toba and his panel are going to discuss the findings, but they're going to look at it in terms of implications as a result of the restrictions and the real domino effect that it's had on businesses in terms of strategic initiatives, key value drivers, and financial planning. So Toba, thank you so much for joining us today. I'm handing over to you and your illustrious panel to just take us through your views, your sentiments, and particularly in respect of the FTI valuation survey results. Thank you.
Thank you very much, Tanya, and good morning, everyone that's in attendance today, and good morning to our fellow panelists. I just want to introduce them one by one. We've got Cindy Mabaso-Boyana, who is the chair of Orca Investment Holdings and also a current board member of MTN Group. We also have Mike Donaldson, who is the current CEO of RMB Covest, as well as Paul Moigeti, who is the managing partner at Sanlam Private Equity. Those three individuals will form part of the panel today, whereby we're going to be discussing in relatively much detail what they've observed, or rather what we've observed in the private equity sector in the last 12 months or so. In particular 2021, just how COVID-19 affected the sector in terms of how it operates, and both at a fund management level as well as portfolio companies. And those observations, we look at it in broad levels in terms of sector consideration and macroeconomic overview, and how those filtered down to strategy. How the strategy was planned, executed, and the initiatives in the strategy, how they were affected. And we also want to look at whether the sector enjoyed any considerable support from government, because we are aware that the government, for example, put a lot of stimulus package to try and counter the effects of lockdown restrictions. So we want to see what observations that they seen in terms of government support, and these government supports, how programs, how have they been treated in the financial statements and therefore in valuations. And the other thing that we're going to look at in much detail is the key value drivers of a business in terms of the operating models, how operating models were influenced, living under a restricted economy and a challenged economic environment, and how that ultimately leads to impairments, and how those impairments have moved from 2020 to 2021. And later in the conversation, we'll then have look at the valuation models themselves, whether the models that have been used pre-2020 have continued being used, and those models, how have they been adjusted to accommodate for COVID-19 related restrictions. And then what we're going to look at in particular there is how they've quantified and adjusted earnings to determine sustainable earnings, and as well as free cash flows, and whether in the discount rate or in the multiples they've been adjusted to account for lockdown restrictions. So we're going to be looking at that at a high level, and after that we will share our valuation report, and also we're going to take on the questions from the audience. Just want to highlight that both members, or rather all members of the panel, have been able to do and execute on deals during these tough times. For example, Sanlam Private Equity concluded Cavalia Group transaction, which was announced sometime in 2021, and that deal won deal of the year for the mid and large cap group. RMB Ventures also just recently concluded a deal in the pharmaceutical sector. It's called Brunel, and then AIH announced a couple of days ago a deal that has been concluded with Future Growth and Old Mutual. So these professionals that are here and part of the panels, in spite of all the challenges during COVID-19 lockdown restrictions, they've been able to deploy capital and conclude deals. So amongst other things, I'm going to ask around what were the key challenges in closing those deals, in particular the pricing parameters and how those were structured in the sales and purchase agreement. Yeah, so I will allow Mike, Paul, and Cindy just to do a short intro of themselves, and maybe by saying one word of how the week has been for them.
Well, let's start.
You're a bit faint, Mike.
Cindy, we'll let you start.
Thanks, Mike. Are you doing the ladies first thing?
Oh, of course.
Yes, thank you very much. And I know Toba has introduced me from an AIH group point of view and MTN. However, it is important to note that AIH has launched a private equity fund. Yes, in these difficult times, we did our first close and second close last year, which has then allowed us to do the deal that we have just done with Future Growth. How am I feeling this week? Overwhelmed. It's been a milestone deal for us, and really a historical moment to have done this deal. So yeah, that is how I feel at the moment. Thank you.
But yeah, I mean, I'll kick off. I mean, just one minor correction. The Brunel deal, I am from RMB Corvus, not RMB Ventures. That is our company at RMB. So I think Corvus was the one that did the Brunel deal recently. But yeah, I think from a week now, I think also this overwhelming what is happening in the world. I think we go from one crisis to the next. And I think just as private equity individuals start getting our minds and heads around coming through the crisis, you know, I think we've now sort of emerging, I think, much stronger, to be honest. And I think we'll go through those details why I think we're stronger. But I think now heading into sort of a world crisis where I think unfortunately this Ukraine could have far bigger sort of knock-on effects than we initially thought. So yeah, I guess apprehensive, but at the same time it's exciting. much rather be talking valuations to a panel like this than to our auditors, which is a 6-monthly debate. So yeah, I think from that point of view, fantastic.
Yeah, thanks, Mike and Cindy. I think, and Toba for the introduction. As you mentioned, I'm the managing partner of Sanlam Private Equity. We manage a mid-market focused private equity fund that invests predominantly in the South African market, in the slightly upper mid-market space, where we seek to invest check sizes of between 200 and 400 million rand. As you have mentioned, Toba, we launched a new mid-market fund in September 2020. To date, we've done 3 transactions in that fund. One is the Cavalier transaction, which you mentioned, which is a red meat processing business that supplies predominantly to the Woolworths Group. And then the second one is a pet care retail business that's called Absolute Pets, which is a specialized pet care retail business. And the third one, which probably will be announced in the next 2 to 3 weeks, but we've signed the sale agreement, is in the financial technology space. So that's really from our side. How's my week been? Yes, I feel more or less the same way how Cindy and Mike are feeling. Probably the word I'll use is sink or swim. It is a very difficult time, in the market right now. Very overwhelmed. There is quite a lot of activity taking place. From a deal side, but also from the portfolio side, and for us also in the fundraising side. So very, very busy time for us. Thank you very much.
Thanks, Paul. Thanks, Mike, and thanks, Cindy. So what happened in 2021 is that the World Bank projected that South Africa is going to grow by approximately 4%. And the actual results were announced by Stats SA yesterday or day before, that actually the sector, or rather the economy, grew by 4.9%. But in reality, when you look at the growth that has been announced, is that, or recovery rather, that has been announced, is that whilst there's improvement since 2020, and the lockdowns, restrictions have been softened a bit, the economy overall, it's still, in terms of size, in real terms, smaller than it was in 2019 before COVID-19. And the macro picture in terms of outlook still doesn't look great. I think 2022 is projected to grow at about 2%, and thereafter we are projected to grow at about 1.5%. So as much as there is some easing and recovery as a result of reducing the level of restrictions, the economy has still taken a bit of a knock. What I just want to find out from my panelists is how have you observed the macroeconomic picture, and how this has affected, in particular, the private equity sector at both the fund management level company as well as at portfolio companies. What has been your experience in the last calendar year? If you can take that, Mike.
Yeah, sure. Thanks, Taba. So, I think there's been, I think any disruption causes major issues across the portfolio. So, where we sit currently, we've got about 53 different assets. And I think we had a range of different influences in that portfolio and external. So I think, it has been dramatic. I think certainly 2020 was a dramatic year in terms of trying to find our way through, both from a management point of view and the underlying portfolio. So certainly in the underlying portfolio, we had some dramatic issues, given a lot of sort of consumer businesses in there. Effectively, those doors were closed in March, period, April. And again, how does one trade through that? How do we get the how do we carry on with the debt? And I think there were some massive question marks raised in all of us. And I think, unfortunately for us and many of us on this call today, I think the banks were pretty lenient in 2020. I think they really were very supportive, but we certainly found that, where they gave us the support. Covenants were thrown out the window, and we didn't have to worry about those. And I think that sort of support from all the sort of stakeholders actually quite honestly, I think it was a fantastic experience for once to be on the same side as everyone. I think for some of the management teams, and we've always known, you have this A management team, B management team. Certainly for the weaker management teams, they were found out. And I think that sort of macro environment, they couldn't trade through that. And we had a few minor casualties. But again, the bigger businesses and the better management teams, they used it as an opportunity to, the saying, never waste a good crisis. I think they certainly took that to heart and really streamlined the businesses. And I think, coming out of it, as I say, I think the portfolio is in much better shape than we went in. It's both from a gearing point of view, from a cash point of view, from a cost point of view. Unfortunately, the big loser in the whole debate is the workforce. I think across the board, you will see the workforce has shrunk, not necessarily from an earnings or sustainable earnings, but the workforce has definitely shrunk. And I think that's going to play adverse effects for us down the road, where I think from a consumer point of view, we are really under pressure. So I think that's from a portfolio point of view. I think just lastly, as a fund, or not that we're a fund, but we run the portfolio as a fund. From a management point of view, I think we took a different stance, that we never wanted to be closed for business. So we wanted to carry on investing, which we did. I think we did 3 or 4 deals per year. But for us, it's probably putting slightly smaller checks out, not focusing on the sort of 300-400 million rand checks. It was sort of, I guess, dial down a little bit, spread the risk, and do the same number of transactions, but probably just put a small equity check out per year. And that's kind of how we managed Toba. Paul?
Yeah.
Thanks, Mike. Paul, if I can just ask, if you look at the challenges that have been caused by the lockdown restrictions, in your perspective, do you view them as temporary, or you view them as more long-term? And therefore, how have you treated them in your portfolio companies? Do you treat them as once-off items, or have they been adjusted as permanent items that are going to be recurring for the foreseeable future?
Yeah, no, thanks, Toba, for the question. It's an interesting question because I think it is, for all private equity practitioners, and I'm sure my panelists here, as Cindy and Mark, will agree with me that probably the biggest challenge that we had over this period has been to establish what is a sustainable base of earnings in businesses, from an investment perspective when doing deals, but also from a valuation perspective in terms of how to value those businesses. And it's very sector by sector, to be honest with you. We've seen some sectors that actually experienced tailwinds as a result of COVID. And those businesses, and a few probably would be, I'd say, in the home improvement space, where we've seen a lot of demand for products and in that space, and probably the earnings have been higher than sustainable. And the key challenge there is to actually apply your mind as to how you bring back some of those earnings when thinking about valuing them, especially if you're using multiples and future cash flows. And then just to give you an example, in our portfolio, we have a business which I know RMB Covest also has a similar business, which owns about 50 KFC franchise outlets. And for that business, for the month of April 2020 and May 2020, there was no activity at all because the economy was shut down. And when you look at a rolling 12 months in EBITDA number, you have to make an adjustment for for the periods where the business wasn't trading. So in that company, it's definitely the downward trend in earnings was temporary, because as soon as you open up, and actually the experience has been that demand and volumes have been very robust since the opening of the economy. So there are businesses where the impact of COVID has been temporary, and with the easing of the lockdown restrictions and the opening up of the economy, those businesses immediately bounce back. And there are other businesses where I think in some other sectors, we in our portfolio, we don't have exposure, but I do think in my mind, there are businesses in sectors, probably in the hospitality space, where the damage is permanent, and there has been a structural change in those businesses, and the reduction in the base of those businesses is probably a permanent step down. So I think it differs on a sector by sector. For us, where it was quite clear that the easing of the restrictions will result in an immediate recovery, we then use sustainable earnings and then adjusted for the periods where the businesses couldn't trade. And for businesses, for businesses where we would have felt that it was permanent, we'd have probably done a structural step down adjustment.
Thanks, Paul, for that. I think it was a couple of days ago, sometime this week, Adrian Go of Discovery, the CEO of Discovery Group, was speaking on his LinkedIn feed, where he said that I think it's difficult to plan and estimate how the COVID it's going to unfold in the next couple of months, because the way the virus works such that it mutates every now and then. So from their perspective, in terms of how they are planning, is that they want to remain positive and plan and continue optimizing their strategy in terms of how they approach the market. But they want to also at the same time plan for the downside risk in the event that a new variant comes out, be a challenge and affect again the economy. So what I want to ask from you, Cindy, especially on deals that you've just concluded, given the developments of how the disease has gone, I think from where we are now, the cases have gone substantially low, the new cases. I was listening to the radio this morning that the positivity rate, I think it's sitting at about 6.5%. And if you look at that, as well as the talks that there's a possibility that the state of disaster might be removed completely, and then you factor that the fact that there could be a possibility of new variants that might be vaccine resistant. But I just want to find out, how do you then look into the future and plan for COVID-19, in particular, how it will affect the macro economy as well as sectors in which you operate?
Thanks, Toba. Definitely difficult to plan ahead. It's always had uncertainties anyway, but I think at this moment, what COVID has done, it has really demonstrated that you can go to bed today and then tomorrow the whole world has changed totally. So as we've heard, the common words in these days have been agility, pivoting, resilient, and even robust. Because when we were looking at some of these response plans, we needed to make sure that they were robust enough, and we had to look at them strategically. For example, I mean, one of the businesses that one of the deals we did last year is in a large security and risk business that offers services to the banking sector, the mining sector, and one of the strategic changes that came up with it had required us acquiring very quickly, that business acquired very quickly a tech company that develops drones. That has allowed that security business in the last few months to be awarded a large contract in what is a national problem at the moment with our railway lines. So the drone services will be monitoring from a security point of view the railway lines that are undergoing the high theft rates and disruptions that have moved rail cargo onto the roads. So that is one area that we've actually pivoted and moved very fast. But strategically, even ourselves as an investment company, as a fund manager, when we looked at our strategy, because there was financial services and the industrials, in that we needed to make sure that our industrial focus is ensuring that our business leverage technology, like how Bidvest Proticoin had to do. Part of the response plan was also tactical, and I think both Mike and Paul have touched on it. We had one business that is in the commercial vehicle services space, Atlas Panel Beaters, which basically positioned itself in servicing large trucks, and it was also well positioned in the East Rand, large trucks which needed to transport coal, because that was an essential service. So that then demonstrated for us the the resilience of that business. And coincidentally, in the portfolio, we do have a fuel services business that transports fuel mainly to clients like your Escoms and your Sasols. So that too benefited from being in one of the essential services space. And then I think finally, transactionally, those response plans needed to be solid. We've touched on the importance of payment holidays. Those went a long way, but as you can tell at this stage, some of them are now, when you have to plan ahead, you need to take away those, because those are not going to be in existence throughout the periods that we had looked at the future cash flows. So those are some of the things that we had to take into consideration in reviewing some of our strategic responses. So in that response, we have realized that now we've had to stay very close to our investee companies in reviving it now to actually be recovery plans. And how robust are those recovery plans? Are they sustainable? And key to the recovery is the skill. Either the skills, we've realized how scarce IT technology skills have become, and financial skills. Most of our investee companies are now battling to retain these skills. And one of the things we've had to do is to work with them. Thankfully, because of the pipeline that we also work on within AWCA, is to enrich those financial skills with also technological skills in ensuring that we are finding ways of dealing with what every CEO is grappling with, even in the listed entities where I serve. Tech skills and financial skills are becoming very mobile at the moment, and it is becoming a big challenge because some of them are not just moving internally in the country, they are actually being poached internationally, where you can sit here in Johannesburg and earn foreign currency and still stay with your family. And those are some of the attractive professional opportunities that are in the, that are coming up globally. And that is becoming one of the key challenges as you look at being agile in going to the future.
But Toba, sorry, I think you were also mentioning in terms, and maybe Cindy, you correct me if I'm wrong, but I think right now, if you're talking 2020 or 2022, 2023, in terms of the impact that COVID's having on our management teams, I think, to be honest, very little that I've seen. I think more impactful for budgets now and forecasts is this world shortage in terms of containers and shipping. The ports are, the bottlenecks at various ports, and I don't think this Ukraine saga is going to help that either. And I think that's probably, to be honest, I haven't heard in the last sort of round of management sessions we've had the COVID-related issues that we have in the last 2 years. I think it's much more about other pressing issues. I think the rights had a knock-on effect in KZN. And I do think the sort of ports issue and getting imports in on lead times have all been stretched dramatically. And I think that's going to play a much bigger part in our management team's forecasting for the next few years, to be honest. But that's what I'm saying. I don't know, Paul and Cindy, I don't know how you see that.
Interesting.
The supply chain issues are coming up very strongly in most of the businesses right now, and it actually strengthens the localization debate for our economy. But most of our businesses right now are actually having a very tight squeeze, which has increased the logistics cost, because for you to, some have had to actually fly in parts which naturally would have had to be shipped in. And so those are some of the costs that we've had to see spiking. And again, how do you then, model those into the future? Do you look at the different scenarios, obviously, that are going to look at a conservative side that says you may have to just map those costs in that manner for another, 24 months to 3 years. And so we have had to look at different scenarios, but the supply chain issues are a problem in every sector at the moment.
Yeah.
Interesting. Thanks for the insights, Cindy and Mike. Just as results of the poll, the first poll, the question was, what do you expect would be the impact of the COVID-19 related lockdowns restrictions on economic growth in your industry or the industry in which your portfolio companies operate for the next 12 to 24 months? And the results are, by the audience members, is favorable, 21%, adverse, 71%, no impact, 8%. And then on the second question, where it asks, did you adjust the business operating model or that of the portfolio companies to adapt and cope with the challenges emanating from COVID-19 related lockdown restrictions? The audience response is that yes, we did adjust the operating model, and that's about 87% of the participants in the audience. Thanks for your comments and responses on the poll. Just to move along this discussion even further, I understand that government stepped in to try and soften the blow in terms of the effect of the economic effects of this lockdown restrictions, and they came up with various stimulus packages, which include, amongst other, tariffs. Have you seen any of these stimulus packages being accessed by some of the portfolio companies that you look after? Can you take that? Okay.
Yeah, I think initially, definitely, I think a lot of the companies took advantage of the TERS scheme. Unfortunately, we always knew, government couldn't keep that going forever, and it was never going to be a sustainable business model for a long period of time. So definitely in the first few months, the TERS was definitely taken advantage of, and that was probably across the board in probably, I'd guess, a big percentage of our portfolio. But really, once we'd got into the latter half or middle of 2020, a lot of those schemes fell away, and I think that was the incentives, rightly, were sort of aimed at much smaller SMEs, and I think they got the bulk of the advantage, to be honest.
Yeah, I was going to share the same experience, Mike. I think we saw exactly the same. Probably the first 3 months of COVID, there's a lot of benefits that we saw, especially in our KFC business, where tariffs really came to the party, and we were very grateful for that. As a result of that, we managed to retain our entire workforce in the business. We never had a single retrenchment, never closed a single store down. So I think we saw that support. But I think after the first 2 to 3 months of the lockdown, the tariffs benefit and obviously wasn't there. And luckily, the economy started opening up. And for that specific business, I think with the opening of drive-thrus, that was the catalyst of the recovery for the business.
Okay.
I think by and large, you probably find most of the private equity businesses in SA are probably larger than where the main incentives were aimed. I think a lot of that small sort of family-owned businesses where you've got probably 10 to 15 employees, I think they probably got the bulk of those advantages. And probably rightly so, to be honest.
Yeah, and I think what has obviously now assisted is the fact that as tariffs tapers off, it was good to see the budget speech announcing ETI at least increasing up to about 1,500 per employee. And those are some of the things you need to then make sure that the investee companies are preparing themselves for and are ready to, to be able to get them. Yeah.
Yeah. Just an interesting observation in our survey, contained in our survey. the private equity participants said that based on their experience, Impairs was one of the incentives that was used the most or was accessed the most by the portfolio companies. Just by the way, our survey was based on the responses of 20 participants that participated and concluded the survey, and majority of those were private equity participants, but 13 of the 20. So it's interesting to see that the TERS was used, and it was successful, and it helped quite a lot in terms of aiding the businesses. Now, the next question that I have for the panelists, as we drill deep lower to the level of companies, how did the companies treat these challenges in the financial statements? Did they record any impairments that you observed in 2021? And what is the nature of these impairments? Were they more than extraordinary, or was it normal impairments, or there were no impairments at all that were recorded?
Yeah, Tab, I mean, I think for myself, from looking at the portfolio, most of those impairments were not done at a sort of an investee or target level. I think obviously they traded as best as they could. I think the stock and the inventory and debtors, by and large, I think kind of stood up pretty well. As I said, the banks were pretty flexible. Most of the customers had financial support in the back end from the banks as well. So there was no reason to provide at a sort of investee level. The accounts didn't look marvelous. The time we got to the end of December, you can imagine there was a lot of losses, and you know, there was certainly nothing like an EBITDA to talk about. So really, I think the provisions we talk about is much more at a sort of a fund level, where we had to overlay and try to do valuations and overlay provisions at that level. And that's what we did. It's certainly far easier to talk about provisions than starting to change methodologies on valuation and all the other stuff that we can talk about later. But yeah, it was very much around putting an overlay at a provision to be conservative. But we really didn't let the underlying management teams in each one try and do a specific provision, unless it was permanent, which I think Paul mentioned earlier. So where there was a permanent destruction in either the debtors or the stock or something, then there would be a small provision coming through. But by and large, it wasn't at that level. Don't know how the other two found.
Yeah, so we saw it at an asset level, but also where goodwill was carried, and we needed to impair the goodwill, especially on one of the businesses that had incurred losses, and it was not clear, given their recovery plans, that it was not convincing enough. So we ended up having to impair the goodwill that they had carried in their books for some time. But another impairment that was actually quite interesting was on the deferred tax asset, because again, that was carried on the understanding that they will soon be earning, positive earning profits that will allow them to utilize the deferred tax. And we ended up having to just impair that fully.
Yeah, from our side, we fortunately, our portfolio didn't have any businesses that required an impairment in either goodwill or any of the balance sheet items. From our side, I would have thought probably one is one Cindy's touching on now on goodwill, but even for those, it has to be the theme or the principle would have been to look at whether there's been a permanent structural change in that sector where that business operates, and the debate with auditors would be around using sustainable earnings or sustainable future cash flows or normalized future cash flows, to measure the goodwill in those businesses and not rush to impair the goodwill.
Thanks, Paul, for that, and Cindy and Mike. Now, just to recap, I think what happens is that when you value an asset, what's critical and the approach that we normally take as valuation practitioners at FTI is that we look at the broad macroeconomic issues And we try and understand those and how they filter through into various sectors in which companies operate. And then from there, what we then look at is the strategy which the board and management are adopted or have adopted to grow the business, and how that filters through into the business plan. And once we've looked at that, we then look at the entity itself, its operating model, how the processes of that entity work, key drivers, and then how all of that culminate into the financial performance of the business, the free cash flows of the business, and then perform our analysis there to establish what is the quality of earnings, what is the sustainable earnings that we can use to estimate the value of the business using the market approach. We do the same with the income approach, where we look at the business plan from a strategy point of view and how it filters into the free cash flows, which is a function of earnings, capital expenditure, investment in working capital, and then look for an appropriate discount rate to adjust those earnings to come up with a correct enterprise value that can be used to estimate the equity of the business. So that is a key consideration, and hence our discussion has been sectoring, or rather have been centered around strategic issues, macroeconomic issues, and the strategy and operational models, and how these were affected in the business and how it translates into the financials. So one of the things that I want to establish from the audience, rather not from the audience, but from the panel, is how did you come about looking at sustainable earnings in 2021, with all the challenges that we've looked at from a macro perspective, with all the challenges we've looked at it from a strategy and business planning perspective? What are the key factors that you looked at when you were estimating sustainable earnings and free cash flows to firm? And in particular, in arriving to those sustainable earnings, what is it that you treated as once off, and what is it that you accepted as permanent adjustments?
I mean, yeah, and again, I think Paul mentioned it earlier, but I think really a lot of us, and again, I think we've all viewed this as a temporary change. I think in any valuation debate, to change a methodology from some sort of shock or something in the system, unless we believe it's permanent, there was no reason to go and change the whole methodology and try and sort of revalue our portfolio differently. So I think we all looked, and most of us have got a long history of portfolio companies where you at least had the history from all the way from 17, 18, 19. And I think 19, to be honest, 2019 was probably the base we used for a lot of our valuations. So, we would have had a trajectory up to that point. We knew if a company was sort of maintaining its margins, if it was growing by, call it 5-10% per year. And I think really one had to take a very aggressive look at 20 and 21 to say that is not normal. We don't believe this is COVID. We will find a solution to this. The world will recover. And one couldn't then just play with the valuations or earnings just in those 2 years. So for us, it was about 19. If we believe the company was under pressure before, if it had competition issues, if it had margin pressure, we probably would have softened the margins in the sustainable earnings. But we really would have tried to take a longer term view. And I think there is a lot of guesswork. Valuations is certainly not a science, it's much more an art. And we really use that art to probably to the limit. And but we didn't try to be sort of, to try and take a view on 20 or 21. Very, very difficult to look at sustainable earnings in those years. But one always had the revenue base, and you had to apply a reasonable margin, and maybe one could be a little bit more conservative on those margins. But yeah, possibly aggressive, but I think that's the way. We just didn't want these massive shocks, especially from a Corvus where we fit into a listed vehicle, which is first rand. Ultimately, the last thing you want is to be putting big shocks through the system. And once you come through COVID, then you've got this massive revaluation again, which is not something we wanted to do. So yeah, slightly different for the other two panelists who are obviously much more fund-based.
Yeah, one of the things that we noticed was that in one of the businesses, for example, in 2021, they returned to profitability. And key to that was very aggressive cost cutting. And one of the questions we kept on asking is the sustainability of that, because the revenue line was very benign in terms of the growth. And so it was important to make sure that those cost savings are sustainable as you go forward. There was also a pulling back on maintenance in some of the businesses, and one needs to understand the cycles in that, in that industry, in that business, in knowing that at what point will we actually be hit hard with the maintenance costs that, we probably had saved on. So it was important to unpack some of these savings, and in particular, understanding the industry and some of those value drivers and those cost drivers, because it looked convincing at at face value. One of the things was is travel costs. A number of organizations have saved on travel costs. I think there we could accept that very few organizations want to go back to the level of traveling that used to happen before, and are leveraging this opportunity of the new discovery that effective meetings can be held, virtually. However, once or twice a year, you need to then be able to get some, face-to-face engagement with some of the key stakeholders. The issue of, some of the payouts that were made internally and also externally to the communities where the business operated. Indeed, those were largely once-off. However, it was important in the wake of ESG, especially focusing on the S. And I think last year, again, it forced businesses to take the S seriously than us only leaning more on the E when we talk ESG, because everybody, I think there's been heightened awareness and a lot of work being done around the climate change and investing in that, because that too can be capital intensive. In one of the energy businesses, the technologies that have had to be invested in that space. So the E was obviously flowing, but the S and the G, the social and the governance, demonstrated that some of those things was you would not spend at the level that you did during COVID supporting communities, but it is something that as businesses, we need to be conscious of and continuously find ways of being relevant and being on the ground. Because if you look at even the World Economic Forum has indicated that civil unrest are going to be something that we're going to see. So it wasn't just a South African thing last year. So it's been important for us to also understand how we are factoring that as a business sustainability measure as we factor in ESG.
Thanks, Cindy. If I can ask Paul, from a pricing perspective, how did you structure pricing consideration in the purchases and sales agreement? I understand that PE in the past has been in favor of when you do acquire, there's no terms and conditions attached to the purchase price based on the valuation. So in other words, when you pay out once for all. Has there been a change given what happened in COVID, where you structure the purchase price differently, putting in mechanisms like deferred payments or any other sophisticated structuring terms?
Yeah, thanks, Toba, for the question. And luckily for us, on the deals we actually did conclude, where there wasn't a need to adjust for maintainable earnings or sustainable earnings, because those businesses actually were growing businesses, and they were experiencing tailwinds from the COVID environment. So we managed to acquire businesses that are actually experiencing a positive outcome from the COVID environment. However, because we are active in the market and we are looking to acquire businesses, we have made a few expression of interest, or made a few offers for companies over the last 24 months. And most definitely we have introduced where there has been a debate around sustainable earnings, or there has been a dislocation or differing views between ourselves and the vendors on the other side around where earnings are going. We have most certainly introduced deferred payment structures. And I think that's actually will be a probably, as much as we don't like them, because they defer the marriage, so to speak, and the alignment of interests, because, you know, for the first 12 months while you're waiting for management, you sort of are working against one another. So that's the reason why we don't like them. But most certainly we have introduced those in some of the offers or expression of interest that we have issued in the market, especially where from a valuation perspective, there is a dislocation between ourselves and the sellers. We probably like the business in that scenario, but we think that there may be a way to bridge it. And then we have introduced a deferred payment structure. So that's been our experience by and large in the market.
Thanks, Paul. And on poll number 2, one of the questions that has been asked is, how have you treated financial effects emanating from the COVID-19 related lockdown restrictions when calculating maintainable earnings? Are they considered as once-off or permanent? And majority of the participants said once-off, about 89% of them. I think given the time constraint, what I'll do is I'll just ask the panelists one of the questions that are that's been raised, and then I will open up the discussion for 1 or 2 questions from the floor, and then we will hand over back to Tanya. So one of the questions that have been asked is, have funds sought to take advantage of tools like distressed investing and business rescue turnaround schemes? Who wants to take that, Mike?
Yeah, I mean, I'll start. No, I don't think so, Tob. I mean, I think everyone's in private equity, I think, has stuck to their knitting by and large. I don't think anyone's tried to suddenly jump on the bandwagon and change their business model. So, I mean, if we suddenly started looking at turnarounds and business rescues, we don't have the team, we don't have the history of that experience. So I think there are other industries and other sort of businesses that have climbed into that with probably a far more consultant background, and I think they have certainly probably benefited from some of those turnarounds. But I haven't seen too many mainstream private equity shops suddenly change their mandates and become opportunistic like that.
Okay,
Paul?
Thanks for that, Mike. Is there other questions? Maybe someone in the audience that wants to raise a question for my panelists. I think given the time, I'll only be able to take 1 question. Anyone who has a burning question that they feel wasn't addressed here that would like to raise?
Maybe that question just on the supply chain, and I think it's becoming a more pressing issue at the moment. And I think there's a question around what are the opportunities. I think Cindy did touch on it. I think the supply chain issues, if anything, are going to be positive for some of the smaller SMEs in the country in terms of local manufacturing. You know, and they started years ago with sort of local is better. I do think now, you know, no one was going to move local just because it felt good. I think when there's a commercial and a rationale for that, I think business leaders will move in that direction. Right now, to have a local supply, I think is going to be an absolute asset in any business's artillery. So let's see how it plays out. But I do think if one has got a local supply or a manufacturer, I think those could be in favor over the next sort of 24 months.
Yeah, that is correct. And DTI has positioned this by putting up a few master plans to reform industries like the auto, textiles, the sugar industry. And in fact, in the auto space, they've even put a fund together that will fund local component manufacturers. So there are always opportunities in the middle of any adversity. Yeah. But certainly I think like Paul, we have not, or rather Mike, we have not changed, by the way, our own, fund strategy. We do not look at greenfields. We look at businesses that have got a positive track record.
Thanks, Cindy. Nokuthula Mtomboti has a question. If you can just unmute yourself and raise the question. Noktula, can you unmute yourself and raise the question? Okay, I think we've lost her. I'll just give each and every one of you a minute, each just the closing remarks that you want to share with the rest of the audience.
Yeah, happy to go first. Thanks, Toba, and for the opportunity and for the lovely discussion at the panel. I think from our side, from a Sanlam Private Equity perspective, I mean, we are feeling very positive. Well, before the Russia-Ukraine, we came into there feeling very positive, I think, around investing in private equity. I think from a vintage perspective, we thought this would be a very good vintage to be investing in businesses and taking equity risk in the market. And there are certain industries in the market that are currently swimming against the tide, despite the structural issues that we have in the country from a macroeconomic perspective. So we remain on the lookout for opportunities. We obviously hope that the Russia-Ukraine issue doesn't escalate and the ripple effect thereof, around inflation, etc., and food supply, etc. And I think if that does get arrested quickly, we will still experience a positive environment from an investment perspective in South Africa.
Thanks, Paul. Cindy?
Thanks, Toba. From my side, I think COVID and also the war has just demonstrated that globally we've been looking at the emerging markets as those being the most risky ones. And I think these last two global events have demonstrated that COVID, you could see that it's mainly developing countries that were hard hit. And even with the war being central in Europe, is also for us, presenting opportunities that we need to look into, whether intra-trade across the continent or even ourselves locally in South Africa. So I think that point of opportunities for us in ensuring short supply chain processes is, I would seriously like to emphasize it. Thanks.
Mike?
Yeah, Tom, I mean, and again, I was just looking back the other day. I mean, Corvest has been going for it's over 31 years now, and I think we would never, ever have thought that something like this in terms of COVID over the last few years, where the world shut down, that these businesses and portfolios would have survived. And I think the fact that most of us have come through relatively unscathed, I think the portfolios, as I say, are probably in better shape than they ever have been. I think the gearing is probably the lowest it's ever been in most cases, because one was either forced to put more equity in or just trade out of those positions and not be too aggressive. So I do think private equity is very well placed over the next couple of years. I think this localization is going to become a theme. I think government for once is standing by it and is starting to deliver. And we see that certainly in the automotive sector. And I think, barring sort of more shocks like the supply chains issues, like the Russia invasion, I'd like to think, I think private equity right now should be in for a pretty good period over the next 24 to 36 months. I think, if you look at every single founder out there in terms of what we buy, those businesses are all 3 years older. So all the 60-year-olds that wanted to sell 3 years ago are now 63. And that's the lifeblood of private equities, that succession. And I think yes, deals have been done in the last few years, but certainly nowhere near what they were sort of pre-COVID. So I think we're excited. I think we are going to see a flurry of activity over the next 24 months. And let's hope we through, and it does appear that we are through the worst of COVID. And hopefully that's just a good lesson that we've all had.
Okay. Thank you very much, Mike, Paul, and Cindy, for your great insights. We truly appreciate it. I'll now hand over to Tanya to wrap off the conversation.
Thank you, everyone. That was a really insightful conversation, and some quality questions that came through from the audience as well. One of the questions asked about the number of participants being only 20, but I think it's a good yardstick in terms of what are the trends, and it's up to you then to compare how it relates to your particular context. I think it's unfortunately a product of the industry is that we always battle to get our members to complete surveys. So this is also a call to action for our members to really participate in these surveys if you want quality data and information. Whether it's FTI Consulting, whether it's SAFCA, these data points are really important for our advocacy work, but also just for you in terms of making business decisions for yourself. In terms of some of the questions that were asked, I think the topic of localization, impact of unrest, all of these are very topical, very important questions specifically for South Africa, and we're hoping that we'll either address that in more detail in future webinars or at the SAFCA conference, where we've got various tracks that will look at conversations and co-creating solutions for the industry. So we hope to see a lot of you there. Thank you so much to the panel. Thank you to FTI Consulting, and I hope you will all download the research, have a look at it, and see how it impacts your particular business and environment. Have a great day, and hope to see you at the next event.